Hello everyone, we're back at it again. It's your guy AdmamFX, and in this video I'll be teaching you guys what the heck this thing called Forex really is. So guys, this is a beginner tutorial Forex video. So if you are watching me right now, you probably want to know more about Forex trading. So before we dive into the world of Forex trading, I want you to please smash that subscription button below and kindly give this video a like button. That's if you like the video after watching it, which I know you probably would. YouTube is also going to spread the video to other audience who might also be in need of this particular video. Guys, one of the main reasons why I made this beginner tutorial video is because a lot of videos on YouTube are complicated and you won't really understand it as a fresh beginner. So I want you to please watch the video to the end because I know you would probably enjoy the video and learn a lot by the end of this video. So before we get into the professional side of what Forex is, Forex is simply buying and selling. So let me quickly give you a simple analogy. So now, for instance, you bought a biscuit. So now you're giving the money to the biscuit or to the biscuit seller, which is two things of value. Now we have two things of value right here. The money is of value, is a thing of value, while the biscuit is also a thing of value. So now you're giving and then receiving the biscuit. So now you're exchanging two things of value. But right here in Forex trading is simply foreign exchange. So now you're exchanging two currency for one another. So which means Forex trading is simply the simultaneous buying and selling of two different currencies. So let me repeat that once again. Forex trading is simply the simultaneous buying and selling of two different currencies. You know, I said the biscuit is something of value while the money is also something of value. So currency is also money while the other currency is also money. They are both two things of value which you are exchanging simultaneously. So after understanding what Forex really is, so now the question is, how do we make money from Forex trading? So let me quickly give you a quick analogy using my pen. So now let's say the price of this pen about last week was $10, for example, and an investor researched that the price of this pen was going to move from $10 to $20 in about a week or 2 weeks time, right? So now the research he made was right. The prediction he made about why the pen is going to move from $10 to $20, he was eventually right. So as of this week, the price moved from $10 to $20, and then he bought only one pen. So he was able to make a profit of $10 from the pen, right? He was able to capitalize on the increase of price of this pen, right? So that's how you can also profit from the Forex market. So, but I want you to remember that we're not buying pen here, we're buying currency. So for example, you are living in Nigeria and the price of, and you did some speculation and research that the price of dollar is going to increase in value, right? That the dollar is going to increase in value, and then you did what? You sold some naira and bought some dollars. And then at the end of the day, your research were right, the dollar increased in value, and then you sold off your dollars and brought back some naira. So which means you were able to capitalize due to the increase in value of the dollars. So after getting how we make money from the Forex market, I also want you to keep in mind that this Forex market of the thing is the world's biggest financial market, and it is 200 times bigger than the stock market, and an average of $6 trillion is traded daily. So I want you to imagine a very big ocean filled with money. So some go with a small spoon to fetch money, and some even go with a bowl, some go with a very big bucket. Also, I want you to know that for you to move from a small spoon to a bowl to a big bucket, you have to master your patience, your emotions, and your psychology. And some even go to the ocean to fetch with baskets. Imagine fetching water with baskets. As you're making it, you're going to lose everything instantly. And some went to the ocean to get drowned. Trust me when I say some has lost their lives trading Forex due to depression because they lost all their money. And the Forex market is open for 24/5 from Monday to Friday for 24 hours straight up. So our next topic is what is even traded in the Forex market. Like I said earlier, currencies is what is traded in the Forex market. There are a lot of currencies you can trade, and they are categorized into three types. You have the major pairs, the minor pairs, and the exotic pairs. So guys, these are the major pairs. These are the major pairs in forex trading. So in all these major pairs, you're going to see that they have something in common, which is they either have the USD as the quote or the base. Right here, USD, that is the United States dollar. USD right here as the base. USD. So there's something we call the base and quotes. The base and the quotes. So the base is the first pair right here, and the quote is the second pair. The first pair is the base, and the second pair is the quote. The first pair is the base, and the second pair is the quote. So this base right here is USD, while CHF is the quote. So now this base and quotes of a thing and everything you see here is organized by a body called the ISO. So the ISO simply means International Standardization Organization. International Standardization Organization. That's simply the acronym. That's what the acronym means. So this body are the one who organized all these Euro USD and everything, like the name and everything. So there are only 3 letters you can see in a currency pairs. So now how did I get these letters? So the first two, for example, GBP now, GBP. So now the first two is the country's name, while the last one is the country's currency's name, right? So GBP simply means GB right here simply means Great Britain, and Great Britain is United Kingdom, right? And the P right here is the pound. That's the name of their currency. That is the pound. GBP. That's so Great Britain pound. Great Britain pound. So that's how they come across this name. And also USD, you should know that stands for United States dollars. United States dollar. United States and then dollar, the name of their currency. So as a Nigerian guy, you should know that's Nigerian Naira. So that's why you have the NGN as Nigerian Naira. NGN. So this is the Nigerian Naira. You get? So the first letters are the country's name, while the last letter is going to be the country's currency's name, right? Naira. So another example right here, we have AUD USD. AUD simply means Australian dollar. AUD, Australian dollar versus the United States. So that is that for that, guys. So these are the major pairs. So you can see there are 7 in numbers. So you can see that there are 7 in numbers. 1, 2, 3, 4, 5, 6, 7. So these are the major pairs. So now let's go to the minor pairs. So guys, minor pairs are pairs that does not have the USD as their base or a quote, or as their quote. Remember, base is the first pair that appears at the left hand side, while quote is the pair that appears at the right hand side, right? So this is the base and this is the quote, right? So now minor pairs are pairs that does not include the USD as their base or quote. They don't have the USD. USD is not there at all. So that's why they have lesser volumes. These major pairs, they have more volume than these minor pairs. These are the mostly traded pairs in the world, right? So that's why they are major, as the name implies. So now these minor pairs don't have USD as their base or quote, right? None of these pairs has USD as United States dollar as their base or quote, right? So but they have one of these right here. They have one of these pairs, one of the major pairs, right? If you check everything, they have one of these major pairs. They must have one of these major pairs to be a minor pair, but they don't have USD as one of their pairs, right, in the minor pairs. So now you watch, we have Euro, GBP is also here, Euro, AUD, we have it here. We have CAD, we have GBP. So now let's move to exotic pairs. Exotic pairs are pairs of emerging countries. Exotic pairs are pairs of emerging countries, and then they link it up with one major pair, right? So now what do I mean by emerging countries? Countries that are just developing, right? Countries that are just developing, that are still trying to find their way to the top countries, right? So now if you watch, guys, CAD, Canadian dollar, I won't really say Canada is like one of those top countries. So now we also have HKD. To be honest, I don't know what is HKD. I don't know which country is this HKD. So now we have the NZD SGD. We have the GBP. So this is Zambian rand. ZAR is Zambian rand. So we have the AUD MXN. I think that's in Mexico something. So this country, I don't really know them. That's why they are emerging countries. These are countries you don't really know them, right? They are emerging countries. They're just trying to find our way up, right? So now let's move on to the next topic, guys. So guys, before we move on to the next topic, please don't trade these exotic pairs. The spread are very high. You should make sure you always trade one of the major pair or the minor pairs. Don't trade the exotic pairs. They have a very high spread, and they have less volume. The volatility is very low, so don't even trade it. So guys, who are now the market participants who are participating in the forex market? So now, first of all, I want you to know that this right here is us, you and me, we small traders who just want to make a living out of trading. So we just taking small risk-taking individuals who come to the FX market to earn money fast. So that is us, you and me. We are the retail traders. So now the government, I also want you to know that your governments are also participating in the forex market. Markets movers that set economic goals and shake the markets with political decisions. So these people are just here for control. So investment funds, guys. Investment funds are high skilled investors who have a broader selection of investment opportunities. So these are head investment funds. So we have commercial banks, your banks, private credit organizations that do most of the global currency trading through electronic networks. You have the central banks, forex trend centers that control the money supply in a given economy. You have the corporation, active hedgers seeking to protect their profits through buying and selling currency. So these people are also here to make profits. These are corporations. You get, these are corporation. So I also want you to know that this right here, we as traders. So I also want you to know that this right here, we as traders, we only make about 2 to 4% of the forex market. We only make about we are like 2 to 3%. So we are not really that relevant to the forex market. These are the big guys, These are the big guys. We are just here with our small money to make small profit and then leave the rest for God. So guys, let's move on. So what is a forex broker? Broker is simply a middleman between you and the market. So if you want to know more about what a broker is, I made a video. This video right here, go watch it. I explain more about what a broker is. So guys, the forex market session. So guys, we have 4 market session, and the forex we have 4 market session, guys. So the London opens at 8 a.m. That is when the banks of London opens, guys. That is when the banks of London opens. They open at 8 and it closes at 15. The New York is also the second busiest, one of the busiest. They open at 13 and then it closes at 21. And this 13 is about 1 o'clock, and then they close at about 9 o'clock p.m. right? They close at about 9 o'clock p.m. If you trace the time of New York, this is also going to be 8. This is also going to be 8 because in almost every country the banks open at 8 o'clock, right? And the senior also, if you trace that time also, you're gonna see that this is 8 o'clock in their own time, and the Tokyo also, this is gonna be 8 o'clock in their own time. And then this overlap, imagine the London is one of the busiest and the New York is also one of the busiest, and then imagine them colliding, imagine them meeting themselves. The New York is going to be open right here, and also the London is also going to be open. So that is why it brings more volume to the market. It brings more volume to the market. This is one of the busiest times to trade, so there's more volatility in the forex market. There's more volatility in the forex market, guys. So whenever they meet themselves, that's what we call overlap. Whenever they meet themselves, that's what we call overlap. They overlap each other. These also overlap each other. They overlap each other right here. So this is what we call overlap, and that's why. And so this from right here to right here, guys, is the best time to trade in the forex market, because this being the busiest, this being the second busiest, that's surely gonna be one of the best times to trade, because there's gonna be more volume. There are more big money players right in these two countries. There are more big banks, have more money. There are more big players that are gonna trade, that are gonna put money in the forex market. In, like I said, there are some who want to come for profit reason, and there are some who want to come for non-profit reasons. Like the big banks, they are not coming for profit reason, they are coming for control. So there are more big players in these two than any other time, any other market section. Guys, our next topic now is bull versus bear. Bull versus bear. Bull versus bear. So now this is a bull, as you guys know. This is a bull and this is a bear. These are two different animals. So why am I bringing these animals to you? This is a term you're gonna get familiarized with as long as you are in this trading space, because bull simply means buy or long, while bear means sell or short. So now bull means buy or long, sell means bear means sell or short. So now I think why they use bull for going up and why they use bear for coming down is simply because the way these animals attack. So now let's say when a bull wants to attack, it's going to use his horn to drag its prey up, while a bear is going to attack using his claws. By dragging it down with both his claws and teeth, it's going to drag the prey down. So now bull also means when something is bullish, it means a market that's going up. The market is going up, as you can see in this diagram. And when a market is bearish, then the market is coming down, which is also, when the market is coming down, you're going to want to sell, and when the market is going up, you're going to want to buy, which is also long, and selling is also short. You want to long, you want to short, which also means if you want to long, that means you want to buy, and if you want to short, that means you want to sell. So guys, this is a very, very clear example of a market that's coming down. So whenever you say market coming down like this, the term used for this is a bearish market. A bearish market. So this is an example of a bearish market. The market has been coming down. We as forex trader are selling when the market is coming down, and it is also short. So guys, now this is clearly going up. This is a market that's going up. So the term used for this is a bullish market. And another word for bullish, this is a bullish market, guys. It's long, and buy. So when the market is going up like this, we gotta buy. So when the market is coming down, we gotta sell. So another term is for this is long, bullish, long, buy. I hope you guys understand. So now guys, we have the bid and ask price. The bid and ask price. So this bid and ask price, I'm still gonna explain more on it when we get to what is pips and pipet. But for now, the said spread is the difference between the ask and bid price. In this example, the spread is 0.50 blah blah blah. So now what is spread? So now guys, spread is the difference between bid and ask price. So I want to explain the bid and ask price here. So now they said bid is a price at which buyers are willing to buy. Guys, I want you to understand this concept. They said the bid price is a price at which buyers are willing to buy, while the ask price is a price at which sellers are willing to sell. So now, whenever you want to buy in the market, I want you to know that you're going to get filled up at whenever you want to buy, I want you to know that you're going to get filled up at this ask price. So now, why are you going to get filled up at this ask price? Remember, forex trading is the simultaneous buying and selling of two different pairs. So now, whenever you want to buy, you gotta have someone who want to sell somewhere. So now the price at which that person is willing to sell that's where you're gonna buy, right? And also whenever you want to sell, you have to have potential buyers, right? You have to have potential buyers who are willing to buy at a point of time. And trust me, whenever you are in a market session, there's always going to be willing buyers and willing sellers, right? There are always going to be buyers and sellers, right? So now, whenever you want to sell, you're going to get filled at the price at which buyers are willing to buy from you. And whenever you want to sell, you're going to get, whenever you want to buy, you're going to get filled up at the price at which sellers are willing to sell to you. I hope you guys understand. So now, the difference between the bid and ask price. So now the difference between the bid and ask price is now what we call the spread. The spread, guys. The spread. So now, watch what I'm trying to say. The bid price is 1.13281, while the ask price is 1.3287. So now, just minus it. 1 minus 7, the pipet, the last decimal number right here is the pipet. So now my 1.13281 minus 1.13287 is surely going to give you 0.00006. So that's the difference between these two prices, right? That's the difference between these two prices. And for the term I just used, pips and pipet, I'm going to explain to you in our next topic, right? I'm going to explain that to you in our next topic. So now our spread is 6 pipet. Our spread is 6 pipet. So now let's go to what is pips and what are pipet. So pips is an acronym for percentage in point. Pips is an acronym for percentage in point. So now this is what a pip is, guys. So now, for example, human being we walk in steps, guys. As a human being, you walk in steps. Let's say from your parlor, from your living room to your dining, you can move about 10 steps. But in forex trading, price moves in pips, right? Price move in pips. So now these pipettes right here, the last number right here is the pipet. So now the pipet is just like an irrelevant number. Like, let's say in your wall clock, you have the second the minutes, and the hour. So now the pipet is just like the seconds. It's somehow irrelevant, right? It's somehow irrelevant. So now the main one we really need is this pips right here. Pips. That is the real steps. So now this is 6 pips, and when you move forward, this is altogether now this is 86 pips, right? 86 pips. So now if you move forward again to your left hand side, altogether now this is 986 pips. 986 pips. You don't really need to call the pipet. The pipet is irrelevant. The pipet is irrelevant, right? So if you move forward again to your left hand side, altogether now is 1986 pips, right? 1986 pips. So now in a normal forex currency pair, you're gonna have 4 numbers after the decimal point. 1, 2, 3, 4. You're gonna have 4 numbers after the decimal point, but there's an exemption in JPY pairs. But whenever you see a price, just know that the last number is the pipet. Just know that the last number is the pipet, right? The last number is the pipet. So now you're gonna always have 4 numbers after the 4 number, which are pips, not pipet. Like I said, pipets are irrelevant. It's irrelevant. So now you're gonna always have 4 numbers after the decimal point right here. You get? So let's move forward. So guys, for JPY pairs, which are yen pairs, they are an exemption for this pip of a thing. You get? So now, as you can see, we have Euro USD right here. And Euro USD is just an example of what I just taught you, right? 4 decimal numbers after the decimal point. 4 numbers after the decimal point. So this is where our pips start from. This is 1 pip. This is 21 pips altogether. This is 321 pips, and this is 1321 pips altogether. So this is the pipet. Paying no attention to the pipet. So now for yen pairs, and what are yen pairs? Yen pairs: Japanese yen, Japanese yen. That's the name of their currency. JPY. That's the name of their currency. So their own currency has an exemption in how pips are being put in place. You get? So now they have 3 whole number before. So as you can see, guys, they have 3 whole number before the appearance of a decimal point. They have 3 whole number before the appearance of the decimal point. So this is our pipet right here. This is our pipet. Paying attention to pipettes, like I said. So this is where our pips start from. Guys. This is where our pips start from. So this is 1 pip, and altogether like this is 21 pips. I hope you guys understand. Only JPY pairs are the ones that have this exception. Japanese yen pairs are the only one that have this exception. So guys, this is a graphical representation of what I'm trying to explain to you guys. This is a graphical representation of what I'm trying to explain to you in terms of pips. So now, when price was here, price was at 1.11600, and then when price got all the way here, price came all the way down to 1.10450. So now the difference between from this price to this price is 115 pips. That is 115 pips. So now, assuming, for example's sake, assuming we sold right here, we sold, sell. Assuming we sold right here, and then when price got here, we were we were contented with what price has given us, and then we decided to take our profit right here. We closed our profit. Close profit. So now we decided to close our profit right at this price. So now, if anyone asks you how many pips did you catch, you're simply going to tell them you were able to catch 115 pips, because the decline from 1. So now, example, just clear this 1 right here and clear this 0, this last 0 right here. So now you're left with 1160. So I'm just giving you an example of how you can calculate it, better. So now, because this last 0 is Pipet, we don't really need Pipet. So now this one also cancel the 1, this 1 right here, cancel it, and also cancel the 0. So now this is 1160 pips, and right here is 1045 pips. Do you understand? So now 1160 minus 115 pips is definitely 1045 pips. So that is that for that, guys. So I hope you understand how to calculate pips, and you can also go back to some of my previous video where I talked about how many pips I caught in a particular trade and the strategy I used in catching the movement. So guys, for the purpose of better understanding, I don't want the video to be too long, so that's why I'm going to be making a part 2 of this video. Now I'm going to be explaining about what is leverage, equity margin, and so on and so forth. So if you like the video so far, kindly hit the like button, subscribe, and turn on post notification to be the first to get notified whenever we release a new video. See you guys in my next video. Peace out.